Jen got in touch with us yesterday. She'd been saving diligently and finally had a 5% deposit ready to go to buy her first home. But before she called me, she spoke to her mum, who said, whoa, Jen, you gotta wait, save up a 20% deposit, then you can get into the market slowly. So that poses the question, should Jen wait, save up a 20% deposit and get into the market, or get into the market now? And that's what we're going to answer in this video today.
Let's start off from the top and talk about the pros and cons of entering to the market with a small deposit and paying for things like lender's mortgage insurance. I guess the first pro is you can get in the market today. You're not waiting where prices might keep going up and your deposit is never catching up with the sale or the value of prices. The con is, yes, you're going to have high costs for lender's mortgage insurance that can range from a few $1,000s to tens of thousands of dollars. So you can have higher costs there. So I guess it's about weighing up whether getting in the market now made more sense rather than trying to keep building up that deposit, but understanding there's going to be costs associated, which might mean over the long run, you're going to have higher repayments on mortgages and higher setup costs.
Yeah, if you look at it historically, I've had a couple of clients, I spoke for a couple earlier this week. They bought a home in Albany Creek in Brisbane 3 years ago. They paid $550,000 and it was a great deal at the time. It felt like a lot of money, obviously, but they had to pay lender's mortgage insurance and they had a 5% deposit. Fast forward to today, we revalued the property and it's worth over $750,000. It's gone up $200,000 in 3 years. And I asked them, could you guys have saved that over that 3-year period? And they said, there's absolutely no way that can happen. And this is usually the debate with buying a home, getting in the market now with a smaller deposit compared to waiting. Because like Nathan said, the market can keep going. It may not. We don't know what's going to happen in the future, but it's something worth considering.
Definitely. And there are options under that first home guarantee scheme. And this could benefit you from avoiding paying that lender's mortgage insurance. Effectively, the scheme allows you to lend up to 95% of the property value. The government is your guarantor, so you have no mortgage insurance to pay. So once again, it might be the best of both worlds.
Yeah, another adjunct scheme of this or something that's also available is if your parents can help as a guarantor. In this case, you potentially buy a home, you can lend up to 100% of the purchase price. You don't need a deposit in some cases, and the bank effectively puts 80% of the loan against your home, 20% against your parents' home, and you need to make repayments on the whole thing. One question I do get asked pretty frequently is, well, if I'm not working, if I can't earn enough, I don't have the capacity, can my parents help with increasing my borrowing capacity, increasing the loan amount? And unfortunately, you can't. A guarantor loan is only there to help with your deposit. You need to be working, you need to be earning enough to be able to make the repayments on that loan.
Now, a question I get asked a lot is, if I pay the lender's mortgage insurance and I refinance in the future, is there a way to get rid of that mortgage insurance? Now, it all depends on the lender. Some lenders allow you a refund on the lender's mortgage insurance if you refinance or pay out the loan within a 12-month period of time. So it's all about checking with your lender, understanding the terms and conditions of that lender's mortgage insurance when you set up the loan, and potentially if you get capital growth increases over a 12-month period, you might be able to refinance to another lender, pay no lender's mortgage insurance, plus get a refund for the insurance you previously paid.
Yeah, but typically that mortgage insurance is a one-off cost. It's added to the loan up front. You will carry it together, but as in the case of my clients before, if the property value goes up by $200,000, then it's more than paid for itself.
It's that opportunity cost. So if you paid 15 grand to set up the loan 2 years ago, but it's gone up by $200,000, well, guess what? The opportunity cost might have cost you 15 grand to get in the market, but you're 200 ahead. So net, you're really winning from that point of view. Now, if you are trying to save a 20% deposit, what are some things you need to be careful of there, Jaden?
Yeah, so I think the hardest thing is with the way property growth has been over the last couple of years is trying to stay up, because you might have looked at that home, in Albany Creek, like I mentioned, 3 years ago. I need $100,000 to get in the market. The property price is $500, $550. I'm going to get there. Fast forward today, you're trying to get in the market, but it's all gone up to $750. So you need $140,000, $150,000 plus your stamp duty. Your 100 grand doesn't quite meet the 20% deposit. So that's the hard thing where you're constantly chasing your tail a little bit there.
Now, are there any additional costs or any other considerations you need to be aware of when entering to the market with a smaller deposit there, Jaden?
Yeah, so some banks do price for risk. So that means they give you slightly higher interest rates if you have a lower deposit, because you're seen as a bit of a higher risk. If Nathan has a 5% deposit, the bank is lending him 95% of the property value. And if something goes wrong, there's not a lot of headway. There's only 5% to recover their costs. Compared to me, if I give them a 20% deposit, there's an 80% loan against that property, and there's more wiggle room there if something goes wrong. So some banks do charge slightly higher interest rates. Sometimes that can range from 0.2, 0.3% to 0.5%. sometimes more depending on the deposit. So have a chat to your mortgage broker, work through the different options there. Another thing that makes a massive difference with the lender's mortgage insurance premium are the tiers. So if you have the minimum deposit, you have a 5%, 9% deposit, the lender's mortgage insurance can jump up a lot. I was running through a scenario earlier with Ethan. We were looking at him and his wife buying a home. They're looking at buying about $920,000. The lender's mortgage insurance for the minimum deposit, for the 9% deposit, was $30,000. If they could put together another $10,000 in deposit, it dropped to $20,000. And if they could put together another $15,000, it dropped to $10,000. It was a third of the original amount. So keep that in mind. If you're running options with your broker, have a look and see if a little bit more deposit can help get that premium down.
The other thing is ask your parents if they can help. We see a lot of parents that can give small amounts of gifts or even large amounts of gifts that can make all the difference on the purchase and reducing that ongoing monthly commitment, as well as the mortgage insurance like Jaden said. If you have parents that own property, them going as guarantors can also help. And remembering you've got the home guarantee scheme there. So if you do qualify, that's a scheme that is quite important to try and get amongst. So I guess the next question a lot of first homeowners ask is, how does my job history and employment status affect my application?
Yeah, so when you have lender's mortgage insurance, there is sometimes different lending policies. So if some banks, they might have a minimum of 6 months employment if you're paying lender's mortgage insurance or you have less than 20% deposit, or a 3-month minimum employment if you have a 20% deposit. So they actually have slightly double standards, different policies, because there's a lender's mortgage insurance company that can sit behind the bank and they insure the loan. So keep that in mind. They do have different policies. There are a lot of banks though these days that are fine if you're on a probationary policy, if you've only just started a job, if you've been in the industry for a while, they have different policies to cover yourself there.
And that also goes for satisfactory security. So when you buy a property and you're in lender's mortgage insurance, you'll have less than a 20% deposit. Some of the lenders have very specific requirements on that property. For example, if you're buying a unit that's less than 40 square meters, a lot of the times, if you have less than a 20% deposit, the banks aren't interested in lending against that property due to the fact that they see it as a high risk property.
Yeah, I had this the other day for one of our clients we helped out. He was buying a perfectly fine first home. It was an apartment, but it was in a complex in a building that had a lot of short-term accommodation. It also had sort of hotel letting in there. So the bank here applied to initially, just went to his own bank. They said, sorry, mate, like there's no way, this is short-term accommodation, this holiday letting, see you later. He contacted us. We had a look at a couple of different banks' policies, and for other banks, they're completely fine with it. Like, well, this is an apartment. This is fine. You can live in it. You don't have to put it in a letting pool, and we'll lend on it. And this is where different banks' policies come into play, and where one bank says no, it could be a yes somewhere else.
And that's exactly where it comes down to understanding your options, making an informed decision based on what's right for you. So having a minimal deposit or a larger deposit might work for some, might not work for others, but it's about understanding your avenues and options available. And that's where working with a mortgage broker like ourselves can help. Hit us up if you do need assistance at huntergalloway.com.au or give us a call on 1-800-088-065, and we'll see you next time.